This content reflects my personal observations and learning process while studying financial markets and digital assets. Any discussion of trading strategies or market structure relates only to my own trading framework and personal trading system. This material is for informational and documentation purposes only and should not be interpreted as financial advice or a recommendation to buy or sell any security or digital asset. Episode 15, Understanding Crypto Market Cycles. Over the past several episodes, I've been exploring the infrastructure behind digital assets, exchanges, custody, wallets, staking, and how transactions move through these networks. But understanding the infrastructure is only one part of the picture. If someone wants to trade or invest in any market, whether it's equities, commodities, or cryptocurrency, it's also important to understand how market cycles work, because markets rarely move in a straight line, and cryptocurrency markets are no exception. In fact, digital asset markets tend to move through cycles that are often faster and more volatile than what we see in traditional financial markets. A simplified way to think about these cycles is in 4 general phases. The first phase is accumulation. This is usually the period when the market has already experienced a major decline. Prices are relatively quiet, sentiment is cautious, and activity tends to be lower. During this stage, long-term participants may slowly begin accumulating positions while broader interest in the market is still limited. The second phase is expansion. As confidence gradually returns, more participants enter the market and prices begin trending upward. Media attention increases. New investors become curious about the asset class and trading activity grows. The third phase is often called speculation or euphoria. During this stage, momentum can accelerate quickly. Prices rise rapidly. Enthusiasm spreads across social media and financial news, and many new participants enter the market hoping to capture gains. This phase can produce strong upward moves, but it can also create conditions where prices move far beyond fundamental value. The fourth phase is correction. At some point, markets begin to reset. Prices pull back, volatility increases, and sentiment often shifts quickly from optimism to caution. For many investors, this phase can feel uncomfortable, but corrections are a natural part of how markets rebalance after periods of rapid growth. For someone approaching the cryptocurrency market today, understanding these cycles is important. It helps place price movements into a broader context, rather than reacting to short-term headlines or daily volatility. For retail traders especially, one of the biggest challenges is separating market structure from market emotion. Cryptocurrency markets can move quickly, and large price swings are not unusual. Assets like Bitcoin and Ethereum have experienced multiple market cycles over the years, periods of rapid expansion, followed by significant corrections. For traders coming from traditional markets, the key idea is not to predict every move, but to understand the environment you're operating in. Is the market expanding? Is it overheated? Or is it moving through a period of consolidation? Recognizing these conditions can help traders remain disciplined and avoid making decisions based purely on short-term excitement or fear. For someone just getting started in cryptocurrency, the most important step is not chasing momentum. It's developing a basic understanding of how the market behaves, because before capital moves, understanding should come first. And as I continue documenting this learning journey, the goal is not simply to trade digital assets, but to understand how this emerging market fits within the broader financial system. Like any market, The more clearly we understand the structure, the better prepared we are to navigate it responsibly.